Hello, I'm Reits and Ferguson, CIO of CBRE Clarion Securities. Today I'd like to review 2015 and share with you our outlook for real estate stocks in 2016. If you weren't keeping score based on returns, 2015 was a very good year to be invested in real estate. Fundamentals improved as occupancies and rents grew. Earnings growth was strong at roughly 7%, and dividends were paid and grew by an amount equal to the earnings growth. Unfortunately, real estate stock prices did not keep pace, as the markets climbed a wall of worry based on a number of things. First, there was concern about how investors would react after the Federal Reserve increased rates for the first time in 9 years. There was also concern as China's economy continues to slow and perhaps slow faster than expected, and what the implications would be for global economic growth. And finally, geopolitical concerns in Europe based on terrorist attacks in France and increasing tensions in the Middle East all weighed on investor sentiment. This disconnect between real estate fundamentals and real estate stock performance opened up an interesting gap in the valuations of listed companies and the real estate they own. Real estate stocks became simply too cheap for many savvy investors to ignore. We saw a meaningful pickup in the amount of transaction activity in 2015, with over $44 billion of takeovers, which was a significant increase from the levels we'd seen in the 2 previous years. If this gap between listed public valuations and private market valuations doesn't close, we would expect M&A activity to continue again into 2016. As we enter 2016, we see some interesting valuation in the listed real estate space. At the beginning of the year, real estate stocks were trading at an average discount of 8% to the private market value of the real estate they owned, or NAV. And in many markets, those discounts were 10% or more. Since the beginning of the year, however, that valuation gap has widened, and in some cases materially. As the market has climbed the wall of worry even further, real estate stocks have declined nearly 10% in line with the broader market, opening up some very compelling discounts. Now, on average, listed real estate stocks around the globe are trading at over 10% discounts, and we have found that type of discount historically to be an excellent buying opportunity. We believe the current property cycle is likely to be the longest in decades. Economic growth is improving, but at a meaningfully slower rate than in past recoveries. Unlike prior cycles also, we don't have a meaningful increase in new construction. Therefore, economic growth is translating to improved real estate fundamentals like rising rents and rising occupancies. Assuming the world's economy does not fall into recession, we believe that real estate stocks are poised to deliver double-digit returns over the next 12 months. The fundamentals of the real estate business are good. We enter the year with REIT dividends at nearly 4%. That's very attractive relative to the yields on government bonds around the globe. In addition, we expect dividends to grow again in 2016 as they did in 2015. REIT earnings growth will be approximately 7%. That earnings growth will trigger a similar increase in REIT dividends. Even if interest rates were to increase in the U.S. as widely expected, we see the possibility for strong performance from REITs as highly likely. In fact, historical periods of economic growth coupled with rising interest rates have been some of the best periods for listed real estate stock returns in history. If all of that doesn't add up to a recipe for improved performance, we believe that REIT valuations will prove simply too compelling, and we would expect an increase in the transaction activity that I alluded to earlier to continue into 2016.